In exercise 4-7, we're going to do a process which is called closing entries. Now we do this after we prepare our financial statements and we're getting ready to bring our accounts into the new fiscal year. So when we do that, we have to get rid of all of the balances in the temporary accounts. So to start off with, we're going to focus on the balances in the revenue accounts. So right now I have interest income, a balance of $490, and I also have subscriptions revenue for $71,400. So what I'm going to do is do a journal entry to reduce these amounts, so then it'll bring it to zero, and then I'm going to dump it into this temporary account called income summary, and it's just part of the process. So my first journal entry to do is the subscriptions receivable, and since the original balance is a credit of $71,400, if I do a debit to $71,400, that will bring it to zero. Now the other revenue account that we already earmarked was interest, interest income, and that balance was a credit of $490. So if I do a debit for $490, that will bring that balance to zero. And now if I add those two together, I can put it into this temporary account called income summary. So the $71,400 plus the $490 equals $71,890. So now I've just taken all of the revenue and put it into income summary. So I'll just draw these accounts. So I had interest income, of $490, and I had subscriptions revenue of $71,400. And by doing that one journal entry, so here's the debit and here's the debit, now I balance out this account and it's zero. And I balance out this account and it's zero. Now where did these two amounts go? The $490 and the $71,400 went into that newly created account called income summary. And that was the $71,890. Okay, now here's my second step. We're going to take all of the expenses and do the same thing. We're going to bring those balances down to zero and then move them into the income summary account. So if I'm just looking at my trial balance, I see depreciation expense of $1,700. I see rent expense of $17,900. I see salaries expense of $61,400. And I believe those are the only three expenses that I see on this company's books. So what I'm going to do is I'm going to credit each of these accounts for the same balance, and then that will bring those T accounts to zero. Okay, so I said I'm just going to leave with a blank line here. So I'm going to start with my three expense accounts. So I have depreciation expense equipment, and it was a debit of $1,700, so I'm going to credit that for $1,700 to bring it to zero. Then I had my rent expense, and that originally was a debit of $17,900, so I'm going to credit that for $17,900. And then I also had another credit for the salaries expense. So now I'm going to credit that amount for $61,400. And if I add all those debit accounts together, and I'll put it into the income summary account, that ends up being $81,000. So if I credit my expense accounts, which are always debits, that brings the balance to zero. Okay, so I'll just set up the T accounts here. So I have my depreciation expense, and that was the $1,700. I have my rent expense, and that was the $17,900. And then I have my salaries expense, and that was the $61,400. So with that journal entry I just made, I moved $1,700 out of depreciation to make that 0. I moved $61,400 out of supplies or salaries expense to make that 0. And I moved $17,900 of rent expense out to make that 0. And then those three together, 1, 2, 3, ended up going into the income summary account at $81,000. So now you'll find all of my expenses are now sitting in income summary, and all of my income is sitting in income summary. Now my third step is to close the income summary account out into my capital account. So I just have to figure out what I have. So technically, if I have an $81,000 debit and a $71,890 credit, that means I have more debits. So I have a debit of $9,110. So if I want to bring this account to 0, I'm going to have to credit this income summary account. Now, this isn't always the case. Sometimes you can end up with a bigger credit, meaning that the company has income. So if that was the case, then you would just do the opposite. So I always like to just draw a T account to see where my balance is, and then do the opposite to bring my balance down to 0. Okay, so I'm going to credit my income summary account, and then by default my debit will end up being the capital account. So Trish Norris Capital. Okay, so just by doing that, we'll see that my credit from the last journal entry just brought this income summary account to 0. And now if I open up my capital account, so Trish Norris, I'm just going to take the original balance in here. So I already have $46,810 accumulated, so I'll put that in here. I just transferred the loss from income summary, so I'll put that in here. So that one went right there. And now what I'm going to do is close out my withdrawals into the capital account. So the withdrawals are right here. So the 1980. So that's going to be my last journal entry. So the withdrawals were a debit of $19,800. So if I credit that, I'll bring that balance to 0. And then I'm just going to put that directly into the capital account. $19,800. Okay, so just to see what we did, just using the T accounts, is I take Trish Norris, my withdrawals, and my original amount was that $19,800, and then I moved it with that journal entry, so I did a credit, so that balance is now 0, into my capital account, $19,800. So then if you add everything up in your capital account, you'll get $46,810 minus $9,110 minus $19,800. That means we'll end up with a balance in the capital account of $17,900.